Hi, welcome to a PSL Demo Day. I'm Jason DeBacker, an Associate Professor of Economics at the University of South Carolina and President of the PSL Foundation. I'm going to be giving the demo day today. I'm going to talk about the cost of capital in times of high inflation. So in the United States, we've had more than a year now with inflation above 5%, with most recent numbers coming in at around 9%. I maintain the cost of capital calculator and been thinking about how these high inflation rates are affecting the incentives for businesses to invest. I want to share what I've been thinking about with you today. So let me go ahead and share some slides. All right, so my talk is going to focus both on the theory through which high inflation will affect the cost of capital and also provide some empirical simulations to kind of quantify this effect in the US at present. So let me begin by showing the equation for the cost of capital as derived by Hall and Jorgensen in their 1967 paper. They derived this equation where the cost of capital is a function of the firm's discount rate, tax policy, and the rate of depreciation by equating the cost of capital with its flow of benefits. All right, so this cost of capital here is going to be a function of R, the firm's nominal discount rate, pi, which is going to represent the rate of inflation. That's what we're going to focus on here in this talk. Delta, the rate of economic depreciation, as well as tax policy, both the statutory corporate income tax rate U, as well as how the income tax code allows businesses to deduct their investments. So Z is going to represent the net present value of depreciation deductions for an unit investment in capital. So where does inflation come into play? There's going to be two places in which inflation impacts the cost of capital. The first is through the firm's after-tax real discount rate. That's on the numerator in the first term on the right-hand side of the equal sign in that equation for the cost of capital. The second place through which inflation is going to affect the cost of capital is through the real value of those depreciation deductions, the term Z in the cost of capital function. Let me begin by looking at the nominal discount rate R. So the nominal after-tax discount rate is given by the following equation. Here, F is representing the fraction of investment financed with debt. So 1 minus F is the remainder, the fraction of the investment financed through equity or retained earnings. Investments financed through debt are going to have an interest rate associated with that debt. We'll let I represent that nominal interest rate. Now, at least a portion of those interest payments are deductible against the firm's corporate income tax. So 1 minus K times U is going to represent the fraction of interest payments that remain after some of them are deducted from the income tax, where U is, again, the statutory corporate income tax rate. K here is the deductible share of interest paid. Equity is not going to be, the cost of equity aren't deductible against the corporate income tax. So when the firm finances with equity, they pay the real return on equity E, that's what the shareholders demand. And then to turn this into a nominal rate, we add to that E, the rate of inflation. Through the Fisher equation, we're going to have across the economy that nominal interest rate, the rate paid on debt financing from the firm, is going to be equal to the real interest rate R star plus the rate of inflation. So we'll let R star represent that economy-wide real interest rate. So kind of putting that into our equation for the firm's nominal discount rate and just doing a little bit of algebra, we come out with the equation where that nominal discount rate is equal to a function of the real rate, the rate paid on corporate equity, and then this inflation term. And that last term in this equation is the key one to focus on here, how inflation is impacting this nominal discount factor. And you can see that last term, as long as F times K times U is less than 1, inflation is having a positive effect. If it's a fully debt financed investment, corporate income tax rate is 100%, and you can deduct 100% of your interest payment, F times K times U is 1, and inflation will have no effect. But in general, we're seeing inflation is going to have an effect on the nominal discount rate R, and as inflation goes up, that nominal discount rate is going to go up as well. The real discount rate, R minus pi, that enters that numerator of the cost of capital. Right now, we can just derive this from our previous slide. So R minus pi is going to equal a function of the real interest rate, the real rate paid on corporate equity, and then this inflation term, minus F times K times U times pi, right? That last term is negative. F, K, and U are all non-negative values. The share of debt financing F, the share of interest deductible K, and then the corporate income tax rate U. So as long as those are all not zero, then inflation here is going to lower the real after-tax discount rate. Again, this is what comes into the numerator of the cost of capital equation. So that lower real discount rate is going to lower the cost of capital. So higher inflation is going to decrease the real discount rate and decrease the cost of capital along with it. That's the first channel through which inflation is impacting the cost of capital. Higher inflation lowering the cost of capital in this case. The second channel is through the net present value of depreciation deductions, which we denoted with Z. So Z is computed in a way that depends upon the method of depreciation, whether it's, for example, declining balance or straight line, what the asset life is, and so forth. But for illustrative purposes, let's keep it simple. Just consider straight line depreciation, and that's the equation I've shared here. So ZSL is going to be the net present value of depreciation deductions under straight line depreciation. Here, B is going to represent the rate of bonus depreciation. Y is the recovery period of the asset, the period over which you can deduct those depreciation expenses. And R is that nominal discount factor that we talked about previously. Okay. So if B equals 1, that would represent full expensing, 100% bonus depreciation. In that case, the second term on the right-hand side of the equal sign goes away, and ZSL is just equal to 1. The net present value of those depreciation deductions is 1 because we can deduct 100% immediately. Inflation in that case has no effect. However, if B is less than 1, the second term comes into play. And holding fixed the asset life, we see that inflation is coming and impacting this term through that nominal discount factor. And as we saw a little bit ago, as inflation goes up, that nominal discount factor increases. As the nominal discount factor increases, that's going to decrease the net present value of those depreciation deductions, and Z will fall. The effect of a lower Z is going to be a higher cost of capital. So the second channel through which inflation affects the cost of capital, it's going to lower those net present value of depreciation deductions, which is going to increase the cost of capital. Okay, so we've got a decline an increase in inflation lowering the cost of capital on the one hand and increasing it on the other. Okay, so we've got these two channels and they're working in different directions. They also depend upon the method of financing. So if investment is fully financed by equity, F equals 0, and there's no effect of inflation on the after-tax real discount rate. And so there's no effect on the cost of capital in that case through that first channel. The second channel does affect investments financed by both debt and equity, lowering the value of depreciation deductions in either case. But bonus depreciation would mitigate this effect because more of the investment can be deducted immediately. Okay, so we've got these two channels. They actually work in opposing ways as inflation goes up. And so what we might want to do is quantify what these effects might be to see under kind of current law or hypothetical scenarios, which effect dominates. So I'm going to provide a quantitative analysis here with some simulations from the cost of capital calculator. The cost of capital calculator is a model I maintain. It's cataloged in the policy simulation library. And one can follow along with these simulations and download that model and repeat them on their own. I'm going to use the following calibration. So for tax policy, I'm going to more or less follow current law. We're going to have a statutory corporate income tax rate of 21%. Interest payments will be fully deductible, K equals 1. And I'm going to use current law methods of depreciation, which vary by asset, be it double declining balance or straight line depreciation, and so forth. And as well, I'm going to follow the depreciable lives of those assets, which vary between 3 and 39 years. I will make one deviation from current law for most of my simulations, and I'm going to eliminate bonus depreciation. I want to do this just to think about how, without bonus depreciation, the effects of the inflation on the net present value of those depreciation deductions affects the cost of capital. But I will provide some simulations that show under a purely current law scenario with that bonus depreciation, what the effect of inflation is on the cost of capital. For economic parameters, I'm going to assume the Fisher equation holds, that is the nominal interest rate equals the real rate plus the rate of inflation. For the real rate, I'm going to assume a 3% rate of return. The required return on equity is going to be 5.8%. The rate of depreciation, physical depreciation, I'm going to set to the estimated values from the Bureau of Economic Analysis. These will vary by asset type, anywhere between 2 and 55% at an annual rate. Equity, or excuse me, the financial policy of the firm will vary. I'll look at purely debt financed investments, purely equity financed investments, and then a mix between the two. For the debt equity mix, what I'm going to use is a parameterization where 32% of the investment is financed by debt, the remaining 68% financed by equity. That number just comes from the historical ratio in the United States for debt equity financing among corporations. The inflation rate, I'm going to vary. For most of the analysis, I'll focus on rates of inflation between 2 and 9%, but I'll also expand that range as well to provide a broader analysis. Okay, so first, because the method of financing has such a large impact on how inflation can influence the cost of capital, I want to present some results that differentiate between the form of financing for investment. So I'm looking here at two inflation rates, either 2%, which what it was in the United States a couple of years ago, and what it is now, 9%. For debt financed investments, the red line, we can see that the cost of capital is declining. Here we're looking across all assets. So across all assets, when debt financing is used, the cost of capital decreases from a bit over 2% to about 1% when the inflation rate moves from 2% to 9%. So that's a substantial decrease in the cost of capital for those debt financed investments. This is coming because despite the lower net present value of depreciation deductions, the larger deductions for interest expenses with higher inflation rates offsets that and lowers the cost of capital. For equity finance investments, we aren't deducting those additional costs, interest costs due to high inflation. And we're only seeing the higher cost of capital through the net present value of depreciation deductions declining. And you can see the cost of capital for equity finance investments with the blue line is increasing. For investments financed with a mix of debt and equity at their historic ratios, there's very little change in the cost of capital, maybe a slight decline when moving from 2% inflation to 9% inflation. To see what's driving the increase in the cost of capital, particularly for equity financed investments, where it dominates, is the effect on the net present value of depreciation deductions. And here I'm showing the net present value of depreciation deductions under 2% and 9% inflation by various lived assets. So assets whose depreciable life is 3 years to those whose depreciable life is 39 years. What we see is higher inflation moving from 2% to 9% is going to decrease the net present value of depreciation deductions in all cases. Those effects tend to be larger for those longer lived assets. That's where you have a longer depreciable life over which you're depreciating that asset. Therefore, the effects of inflation are larger. Okay, so higher inflation is going to not just impact the cost of capital, but it's going to impact it differently across various asset lives. And that's what this picture is showing. To show how the net effect on the cost of capital is impacted across these different asset lives, here I'm presenting the cost of capital by depreciable life of asset, again, looking at 2% versus 9% inflation. Not much change in the cost of capital here, right? The decline in the net present value of depreciation deductions, which is increasing the cost of capital, is being offset by the additional deductions of interest expensing. And so not much change in the cost of capital, that increases a bit more for those longer lived assets. Declines a bit more for those longer lived assets. All right, to look again across all assets, here I'm going to show results from where we simulate the model with 0% inflation up to 15% inflation. And here, again, we're looking across all assets broken out by financing type. So in red are the debt finance, blue, the equity finance, and then purple, the mix of debt and equity financed investments. Okay, so as our theory would apply, when inflation is higher, that's going to increase the cost of capital for those investments financed with equity. You can see the blue line increasing as inflation increases. For debt-financed investments, there's two opposing effects, but with 100% debt financing, the effect of lowering the real after-tax discount factor is greater than the effect on the net present value of depreciation deductions, and we see the cost of capital declining pretty substantially as we have higher inflation. For the mix of debt and equity, we don't see much change, okay, in the cost of capital. But what's, one takeaway from this picture is the blue and red lines are diverging here. So the bias between debt and equity financing that is imposed from the corporate income tax system is increasing as inflation grows larger. So as inflation is higher, there's more of an incentive to shift financing away from equity financing towards debt financing, something that's already existing in our corporate income tax system, but the extent of this incentive to shift away from equity financing becomes greater with higher rates of inflation. Right, in this final set of results, I want to show the impact under current law. So the solid lines here represent the cost of capital under current law with 100% bonus depreciation for assets with depreciable lives of 20 years or less. Okay, the dashed lines are the kind of a different scenario in which we have no bonus depreciation. That was what was shown in the prior slide. Okay, so the solid lines here are all lower than the dashed lines because bonus depreciation is reducing the cost of capital through higher net present value of depreciation deductions. What that means is also there's less effective inflation, so there's less of a decline due to inflation with bonus depreciation over time. Okay, and so kind of a takeaway of this is that under current law, inflation has opposing effects on the cost of capital. Empirically, these effects are not large. Moving from, say, 2% to 9% will actually reduce the cost of capital, albeit modestly. So to go back to the previous picture, if we're looking at that mix of debt and equity financing, focusing on the purple lines, and we look at that solid line, which is representing current the cost of capital under current law with bonus depreciation, the cost of capital is declining when we move from 2% to 9% inflation. But the extent to which it declines is not that great. We're talking about just a couple tenths of a percent. Of course, equity finance investments costs are going to increase while debt finance investments costs are going to decrease. To minimize the effect of inflation on the cost of capital, there's a few things that could happen or be changed with respect to tax policy. Essentially, a movement away from our current corporate income tax system and towards a cash flow tax would eliminate the effects of inflation on the cost of capital. That means expensing and a limitation on interest deductions. So if interest isn't deductible from the corporate income tax, and if you can fully expense your investments, then inflation isn't going to impact the net present value of depreciation deductions, and inflation isn't going to affect the after-tax real discount factor because interest payments won't be deductible. In that case, that cash flow tax, you're going to eliminate the distortion between debt and equity financing. And then again, that distortion becomes increasingly important in a world of high inflation. All right, so I hope you found this helpful, tracing out both the theoretical implications of inflation on the cost of capital, as well as looking at some empirical simulations to see how large these effects are. I'd encourage you, if you're interested, to check out the cost of capital calculator. You can download the model, run it on your own machine, or you can use the web application hosted on Compute Studio to run these simulations for yourself or make changes to them to see how alternative tax policy scenarios or alternative economic assumptions would impact these results. Thanks for watching. Hope to see you at another demo day.